20. Investment strategies of Warren Buffett, one of the most important investors of the century. Rule 1, never lose money. Rule 2, don't forget the first rule. Due to the nature of the business, when you invest, the goal is to try to make a profit. But one of the best ways out of this is to try not to experience losses. When you eliminate decisions that can damage your portfolio, there is usually a gain in what is left. Of course, it's easier to increase earnings the more money you keep in your portfolio. According to Warren Buffett, it is better to avoid a loss first and then look at the win than to try to get the biggest advantage. Of course, this idea does not fit into the logic of investors who consider the stock market to be a slot machine in casinos. Don't invest in what you don't know. Definitely don't invest in what you don't understand. Warren Buffett doesn't invest in that sector company if he doesn't understand how a company makes money or if he doesn't know what could fundamentally affect that sector in the next 10 minutes, he said. For example, he is known for not investing much in the technology sector. Do not risk the quality of the company you are investing in. Buffett had followed the path of selling the shares he bought cheaply when he first entered the investment business when they rose. But over time, he saw that it is more profitable to invest in quality companies that promise growth. He even has an important saying about it: time is the best friend of quality companies, the enemy of average companies. High income in the capital creates value and is a sign of an economic ditch. The term economic ditch, introduced into the literature by Buffett, in its simplest form denotes the profitability and difference-making of a company compared to its competitors. Buffett prefers to invest in companies that earn high and stable revenues, for example, 10 to 20% of the capital invested in them. When you get a stock, try to keep it in your hands for a long time. Let's say you bought shares in a quality company at a reasonable price. How long should you keep them in your hands? Buffett has a striking statement about this: if you don't intend to hold a stock for 10 years, it's better not to buy it at all. Warren Buffett is one of the investors who adopts the take-hold logic. There is a high probability that high-quality companies will bring in high revenues and increase their value over time. In addition, he constantly buys and sells shares, dissolves income in the form of taxes and transaction commissions. So it makes more sense to buy shares and wait. Diversity can pose a danger. The concept of diversity, which appears in many fields today and which we are supporters of, can turn into a dangerous concept in the investment world. Let's say you own shares belonging to 100 different industries. It becomes very difficult for you to keep track of what changes are happening in which sector and how these changes may be reflected in your stocks. For example, if you have 60 different feelings right now, it may be a logical move to reduce them slightly. Investing is not a jump camel, but it's not that simple either. Perhaps one of the biggest misconceptions about investing is to think as if only sophisticated people can invest. So this is not a jumping camel job, but remember that there is no possibility that I will choose the easy mode in investing and go through it. And don't listen to anyone who comes out and screams about investing. The best moves are usually boring moves. The bad news: the way to get rich quickly is not to invest in the stock market. It makes more sense to invest in companies that have already proven themselves than to try to find the star of a newly growing sector that will shine in the future. Ultimately, our goal is to find quality companies that will gain value over the years. If we can do this, our portfolio will take care of itself anyway. There is no need to try to become a heroic investor by identifying the rising companies of the future. Remember that beautiful results can be obtained from boring moves. The best thing for most investors is to invest in low-cost index funds. Warren Buffett recommends low-cost index funds, especially for investors whose problem is not to get a fixed amount of dividends. Another important advice of the wise investor is to use the average dollar cost strategy when investing. As the name implies, the event takes place in the form of investing small amounts in a particular asset at December intervals. So, according to Warren Buffett, it is more profitable to invest from time to time, and not all at once. Just listen to those you know and trust. The financial world is full of good and bad people. Unfortunately, there are many people who are trying to take advantage of investors' unrealistic expectations, fears, or eagerness to find the money the easy way out. It is very important to focus on the facts, to be aware of the amount of randomness in the world of investing and not to deviate from the course by entering into realistic expectations. That's why, according to Warren Buffett, it's important to listen to those you know and trust when investing. Don't focus on who likes which stock. Investors need to be interested in what is happening on the market. It's not about who likes which stock or not. By focusing on objective realities, investors are relatively far from sentimentality and can make more useful decisions.